Good afternoon, good evening if you are in East Asia. I'm Nicolas Veron on behalf of the Peterson Institute for International Economics. It's my pleasure to open this new session of the Financial Statement series. And today we'll discuss whether China still wants to attract global investors. It's a timely question, I guess. And we're very privileged today to have two stellar thinkers and speakers to address this question. Wang Tao is the chief China economist at UBS Investment Bank. Dr. Wang studied initially in China at Renmin University in Beijing, where she got her BA in international economics, and then at New York University, where she got her PhD. In 1994, she joined McGraw-Hill as senior Asia economist, and then she worked at the IMF, the International Monetary Fund in Washington, from 1997 to 2006, and working on a number of economic analysis issues. In 2004, she also went back on a part-time basis to Renmin University as an adjunct professor. In 2006, Dr. Wang joined the private sector, first at BP, where she was head of Asia economics, then at Bank of America, head of Greater China and strategy, and from 2008 until now at UBS, where she is one of the most respected and authoritative voices from the private sector on the economics of China. And she also has a regular column in Caixin, the Chinese media, and participates in countless discussions and debates, including on Western media. Nick Lardy is, of course, an Anthony Solomon Senior Fellow at the Peterson Institute for International Economics, which he joined in 2003. He earned his BA in economics at University of Wisconsin in 1968, PhD at University of Michigan in economics as well in 1975. And he's been studying China for now half a century with a depth which is unmatched in the US and pretty much anywhere else. He was a faculty at Yale between 1975 and 83. Then he joined University of Washington in Seattle, where from 1991, he was the director of the Henry Jackson Center for International Studies. And then he crossed the country in 95 to work at Brookings, and then he crossed the street from Brookings to Peterson Institute in 2003. As I mentioned, Nick was also an adjunct professor at Yale, at the Yale University School of Management in the late 90s. Nick Lardy, as I think everybody in this audience knows, has authored countless books and articles very influential on the economics of China, with peerless mastery of the Chinese statistical system, in which statistics convey real and reliable information on China. I will not mention all his publications, but I cannot resist referring to his last two books for the Peterson Institute, Markets Over Mao and The State Strikes Back, which represent maybe a duology or part of a trilogy of which the latest episode remains to be written. So we will discuss that today. With that, over to you, Tao, and we want to hear from you whether China is still welcoming for global capital.
Thank you, Nicholas, for inviting me to this session and to discuss a very important question. And it's a privilege to be in the session with Nick Lardy, whom I've known for many years and learned from for many years. So in the past few months, China issued a lot of regulations on internet platforms, education and gaming, on data security, and so on and so forth. Most of these are actually guidelines and decrees. Only 4 are about amendments of law or law. That's on data security, data privacy, protection of minors, and amendments to antitrust law. I mention that is because with rules and regulations, with guidelines, they do not take a long time, and they can come out in a concentrated period of time, which is what happened. I think, and with not a lot of warning or a transition period. So, and also in Chinese characteristic, there's not a lot of official communication explaining these kind of things. So I think that's probably explains why investors, especially foreign investors, became very concerned about the motivation and what could be next on these. So in our view, why the regulatory tightening on these sectors? Well, in our view, I think a big part of it is actually a rectification of absence or lacks of regulations, especially on the internet space, catching up with, to some extent, global standards or closing some loopholes. For example, companies engaging in financial intermediation should be regulated by financial regulations. And that seems common sense, but it wasn't so in China. Payment companies should not collect underlying personal information from your everyday transactions and sell you other services. That also seems makes sense, but it wasn't so in China. So China tends to be quite relaxed about regulating new industries or new businesses, but when they got big and problems start to appear, then the government regulates. So that's very similar to what happened to shadow banking a few years ago. And so this is the case, is an important factor behind the regulatory tightening. Another objective, I think, is risk control. And Chinese government always care about stability. And so risk control, including controlling financial risk and social risk as well. For example, I think regulating internet finance, especially consumer finance, which could be a social issue, falls kind of into this category. A third reason, I think, is about data security, data privacy, and government oversight. I think in today's world, companies gather more and more data and private information. How they use these data for their profit versus the interest of individuals, government, and national security, I think are not just a concern in China, but across the world. Previously, Chinese rules on this were very relaxed, but it is not surprising, I think, that China has now concerns on the governance of such data and on national security in light of major geopolitical shifts in recent years. There's just, I think, national security concerns across the world have increased. The fourth factor or motivation is about reducing or constraining monopoly power. So antitrust, expanding the antitrust rules to cover internet platforms. And there are, I think most people who are familiar with Chinese internet companies are aware there are rampant monopoly behaviors or practices on those platforms in food delivery or ride-hailing, payment, other online services. So this is about that. Last but the least, I think there's another objective, which is about reducing social inequality and improving social harmony. And I think regulations on education, on internet content, and on improving labor protection, those kind of things fit into this objective. So basically, I think we can conclude that regulatory framework for the internet space has fundamentally changed from not much to something of a framework. But I think this does not mean necessarily that China is moving away from the general market orientation or no longer support the tech sector or digitalization, or they no longer care about foreign investors or private sector. I think in China, in fact, China sees innovation and digitalization as a core development strategy for the future. And the government also does not want to decouple financially from foreign investors or foreign investment. And they continue to want to open. But it does mean that they do not want social risks and financial risks to build up just so that the stock market does well, or that they will protect so-called national champions, meaning major companies, make them bigger or look good. The government wants to play a bigger role in public services like education. Private sector has to adjust and face more regulations in those areas. But the general market orientation, in my view, is not really changed. So I think China still wants continued financial opening. It still wants a vibrant private sector in most of the industries and areas. It's just that they also, at the same time wants to have stronger regulations and more scrutiny especially in some sensitive areas. Another related issue, I think, is about common prosperity that we've heard a lot. Today, a major party publication finally published President Xi Jinping's speech of August 17. I think maybe the public propaganda machine didn't do a very good job because they didn't publish the whole speech before. So there were quite a lot of different interpretations. So what is common prosperity? My simple interpretation is to get rich together. This is let some people and some regions get rich first. That was the motto of the 80s and 90s. But I think now, as China declared it has reached moderate prosperity and is moving towards a more advanced economy stage, a richer economy will have better social welfare and less inequality. I think that's a simple way to put it. It is not a new theme. It first came out in the 18th Party Congress in 2012. It's also not meant to be a short-term goal. It's meant to be fully achieved by 2050. What is new is that the Party Congress and the 14th Five-Year Plan demand action plans on this front, which means some concrete progress in the coming years. And the second thing is that the 14th Five-Year Plan also clearly said that the state will play a principal role in providing basic public services. So that means increase the role for the state and reduce the role and more regulations for the private sector in the areas of basic public services, which they define. There's a list that include basic education, basic healthcare, social protection. I would imagine that would also include food and drug safety, things like that. What are not new is what is associated as main objectives and work focus on common prosperity. They are about increasing household income, especially labor income. It's about expanding middle-class population, which means the government will continue to do that. The government will have to continue to support the private sector, SMEs and services, which are the majority, which they do provide the majority of jobs in China. It's also about improving public services and social safety net, like pension and healthcare insurance coverage and so on, especially for rural and migrant population, because of the huge divergence in rural-urban social access and income area. There will also be gradual tax reform, as China's current personal income tax system is quite flawed. But I don't think really there's going to be a major redistributional change anytime soon. China tends to move on these things slowly and gradually because of anticipated resistance. Nobody really wants to pay more tax, of course. So we can see that actually these common prosperity-related policies, as I described them, are very much in line with earlier policies, a policy agenda about rebalancing the economy, boosting domestic demand, dual circulation, just different terms. But I think the essence of a lot of the policies are very similar. Policies like strengthening employment and labor production, supporting services and SME, enhancing social safety net, and so on, rural development, hukou reform, land reform, shifting the role of the government from investment to providing services. These are all policies that has been on the agenda for at least 10 years. If these policies are implemented effectively, these changes can actually facilitate China's economy to be more balanced and make growth more sustainable economically and socially. So to conclude, I think, despite the concerns, despite there seems to be more regulations and common prosperity seems to be a new theme, but they are motivated by, rectification of some lax rules about risk control and social political consideration. They definitely will have an impact on some businesses, some sectors, lowering some profit margins for some, and maybe some other companies have to change their business models. They could affect private investment in some areas. However, they could also lead, broadly in the macro level to more balanced, sustainable growth and benefit consumption and the middle class. And I think this does not mean that China is turning away from private sector or foreign investment in general. But as I said, it does, I don't think they ever focus too much on stock market. There are obviously other objectives. And so they will not risk these other objectives just to make, stock market or foreign investors do very well. I'll stop here.
Certainly, the last point has been vividly illustrated in recent weeks. I have tons of questions, and as always with China, interpretation is a challenge. But first, Nick.
Thank you, Nikolai, for organizing this session. I'm delighted to share the discussion with Tao. I think part of the answer to the question has to focus on kind of what's the macroeconomic situation in China, and I think it's extremely strong relative to the rest of the world. And I think that's one of the key reasons that China continues to be an attractive place for foreign investors. China's GDP this year is going to be 10-12% above where it was in 2019. Almost all of the rest of the world is still in recovery, and GDP this year will be below where it was in 2019. Now, the only big exception to this is the United States, which will be a few percentage points. By the time you look out at 2022, China is going to be 18% above where it was in 2019. It is the fastest recovering economy in the world, and so its relative GDP performance, I think, looks very good. Part of the answer about foreign investment is to look at foreign direct investment. In 2020, when foreign direct investment globally declined, it went up in China, and China basically doubled its share of inbound foreign investment from something around 13% to fully 25%. In other words, in 2020, 25% of all foreign direct investment was going into China. This year, this very strong growth of foreign investment continues. Last year, the total was 212 billion. In the first half of this year, we're at about 170 billion, way, way, way ahead of the pace of the first half of 2020. And finally, in trade, global trade declined by about 2/5 in 2020. China managed to increase its trade, so its share of global trade went up, and that continues to be the case this year. Cumulatively through August, China's exports are up by fully 1/3. Global trade was up about 4% in the first quarter. The WTO and other organizations are forecasting an increase in global trade of a little bit over 10% this year. That will be pure recovery. That means the level of foreign trade will still be far below what it was in 2019. But China's trade is going to be way, way ahead of where it was in 2019. So I think the kind of big macro picture is a quite favorable one for foreign investors. I'll say a few things on the tech crackdown. I think Tao and I see things fairly similar. I think there's a tendency to overstate how large it is as a share of GDP. It's actually a very thin slice of the private sector. If you look at the recent report on the 500 largest private companies in China, there are about 11 internet companies. They only account for 7% of the revenue of this universe of the largest private companies. So it's a very thin slice. Its contribution to GDP, direct contribution, is actually fairly small. It's less than 4%. The big contribution, of course, of the internet sector is indirect. It allows other sectors of the economy to operate more efficiently. So you think of e-commerce or ride sharing and so forth. So the indirect contribution of the internet sector is quite large, but I don't think there's any evidence that the services that the internet sector is providing have collapsed as a result of the tech crackdown. Maybe in education might be an exception, but if you look at e-commerce and so forth, most of those are still expanding. So if you're an entrepreneur selling your products on the platform company, you can continue to do that, and those sales are continuing to rise. the other indicator, I think, that's very important to look at, and that is what's the share of non-governmental investment in total investment in China. And the picture that's been portrayed in the press and the financial press has been that the private sector is retreating, they're not willing to invest, there's too much uncertainty and so forth. But non-governmental investment has not diminished at all over the course of 2021. It's running at about 56% of total investment. So private sector investment continues to be quite strong. I want to just touch finally on one point. Tao mentioned there are 5 reasons that China has been having this spurt of regulatory moves, and number 4 was antitrust. I think that's a very important consideration for the authorities. I don't think the motivation was to crack down on the private sector. Again, if you look at the details, the internet companies as a group have very high profits. Their profitability, that is profits divided by sales or revenue, is about 3 times the average of private companies. Their return on assets is also about 3 times the rate of return that other private companies are generating. So this doesn't prove anything, but it looks like that sector is generating substantial monopoly rents. And I think one of the goals of the so-called crackdown is to trim the sails a bit of the platform companies, the internet sector. So I think the outlook is generally pretty good, and I don't see China trying to crack down on the private sector or exclude foreign investors.
Thank you. And indeed, that's from both of you a pretty sunny view compared to what you referred to, Nick, as the financial press. And I guess you mentioned you referred to the non-Chinese financial press when you made that mention. There are already many questions from the audience, but let me start with one about timing. Why now? Zuhur Busby is asking whether it makes sense for China to take all these actions when the recovery is still fragile, coming back from the pandemic, with still some outbreaks of the coronavirus here and there. Consumption in terms of retail sales has not yet returned to pre-pandemic level. So why do we see all these initiatives, even if, as you highlighted or interpreted, they're benign? Why is it all happening at this point, Tao?
Right. I think one reason I mentioned is really that problems start to appear, especially financial risk related to internet finance and so on. That's one reason. And some of these rules and regulation may have been in the pipeline for a long time, but various factors may have delayed it. The pandemic last year, and previous to that, the trade war also. And the second reason is what Nick mentioned. The economy in the first half, at least until recently, has been very strong. And so the government saw this as a window of opportunity to implement some structural reforms and structural measures at this moment, when this year they certainly don't have to worry about not achieving the growth target. Even as growth slows down, their target is above 6%, and for sure they will achieve that, even with a negative growth in the fourth quarter, right? So they don't have to worry about it so much. I would venture there's another reason on some of these rules. One is, I think, in the political or geopolitical environment, there's a lot of talks about security and national security and so on. I think China worries about that too. So on data and on content, there's that concern. And also on common prosperity. So another thing is that a lot of these rules, apart maybe from education, I do not see them necessarily as negative for growth. Right? Because, for example, antitrust, it will hurt the profit margins of the platforms, but it will benefit those smaller companies that sell on those platforms because they will have more options and they will face lower charges. Of course, there's a short-term, long-term trade-off. Maybe the pain is more in the short term and the gain is more in the long term. But not a lot of these regulations are definitely negative for growth.
So, Nick mentioned the international financial press. there is, I think, an extraordinary contrast between the kind of business as usual views that both of you conveyed and the way all this flow of news has been relayed in much of the international media. How do you explain the gap, Tao? I mean, you straddle both worlds. You know the Western commentariat very well. How do you explain the extraordinary contrast between what you presented and what we read every day in the Wall Street Journal?
Well, I have noticed that the reporting and the atmosphere outside of China has definitely turned. I've worked on China for over 20 years as well. I think now I have to be very careful. Anything I say could be viewed as biased because I think there's a certain change.
And you're speaking from Hong Kong, where the national security law applies, so we're also aware of that.
Yeah, so no, I mean that I could be seen as biased by the international press, by my American friends, right? Because I think there is a predetermined narrative that, you know, for example, if the same antitrust law, I mean, the US is regulating the internet sector. I don't see the press being as negative on those as the same rules if applied on China. The US is also pushing through some labor protection, a lot of social programs with the current administration. And because of, for example, increased social inequality, they see that as a problem. And China also has that problem, is also addressing that. But when China does that, I think then it's viewed in a different way. I definitely see that. But another way, I think the Chinese government also is not very transparent. And as I said, many of the rules and regulations just come out as department guidelines rather than laws, and that does not give a due process or, you know, fair warning to the private sector, to the market. And the government officials are not very, you know, either willing or effective or care enough to explain very clearly what are the motivations. So I think it's also easy to get confused, not just among foreign investors. I think onshore in China, Chinese investors, Chinese social media are also very confused and feel a bit pessimistic about these changes.
Nick, same question to you. How do you explain the gap away?
Well, I think Tao has explained it pretty well. I would just add one factor. I think reporters are always anxious to get their stories on the front page. And one way of doing that is to hype the story.
So we have a number of questions in the Q&A from Vinay Sharma, from Heng Tran, on how much this timing is related to the political timeline in China and the prospect of the Party Congress next year and the renewal of the mandate of President Xi and control of the political system. I mean, we didn't mention that much so far. What is it something that plays a role, or is it completely outside of the timetable? Maybe Nick first.
I think it's very hard to say. Tao mentioned the lack of transparency, and certainly this applies in spades when you talk about internal Chinese politics, about which I don't think anybody outside of China, and even the vast majority of people in China, have any idea. So, you know, the conventional wisdom is that Xi Jinping is in an extremely strong position. So that would suggest that these moves he's making are not intended to solidify or, solidify his political position in the run-up to the Congress. So that would be one interpretation. On the other hand, as Tao has already pointed out, some of these reforms are very popular in China. Not all of them, with every segment of the population, but I think the improvement of data privacy, cutting back the monopoly power of the big platform companies, I think those will all be seen as we see them play out. I think those will all be seen as very positive terms by the population. So maybe it does help Xi in his move to get a third term as president. I'm giving you an agnostic answer. The honest answer is I don't know.
There is also another element which maybe, certainly is in the Western commentary, which is a crackdown on, plurality of view, dissent, an alternative set of views in education, the possibility for social media to carry critical views of the government. I mean, it's not just about popular measures; it's also about basically giving less space to a pluralistic debate on issues. Doesn't that play a role, Nick?
Well, I think if so, it's very minor. The Chinese Party, the Chinese Communist Party, has had many tools to control discourse in various ways, and I don't see that this new flood of regulation substantially enhances that control. I don't think they have a shortage of control, and I don't think these regulations were designed to shore up that control.
Tao, political comment is constrained. We know that in China and now also increasingly in Hong Kong. But if you want to add to this, you're very welcome.
It's not that I'm constrained. It's just I have similar view as Nick. I don't actually know, to what extent. I tend to agree that this is not that much related. I think the press tend to somehow talk about some magic timing. But I think bureaucracies run similarly in many places. Like rules and regulations take a lot of time for internal debates, and when they finally come through, somehow they come at a time that other people think, oh, maybe it's related to something. I'm not sure. A lot of the rules on internet finance, on fintech, for example, that's been in the works. That's been debated for a long time.
That's right. And our colleague at the Peterson Institute, Martin Chorzempa, has commented on this in the latest episode of the Global Economic Prospects at the Peterson Institute, and that video is also on the website. And I think his comments echoed very much what you just said. Another thing that we haven't touched upon yet, and is very big in the news, of course, is real estate and real estate debt. Evergrande, Fantasia, and other real estate developers which are facing difficulties. It's interesting that it didn't come up in our conversation so far. We have a number of questions from Victoria Ruan, from Boris Maestro-Storovich, from Caroline Atkinson, and also anonymous attendees on this. Can you, maybe one way is, is a pileup of real estate debt playing a role in the timing of what we're seeing in China? It certainly plays a role in the perception by a number of global investors. So how do you view that issue right now, Tao?
So the government has been, for quite a few years, right? This housing is for living, not for speculation. The statement by President Xi has been the running theme of the property policy. And the concern, I think, stemmed from a number of years ago when the whole world was concerned about China's debt and the property, bubble and so on. So since then, the government has been trying to deleverage and to rein in overall debt and also rein in property bubble. So that's not really new, what we are seeing. Last year, the government, as the economy start to recover from COVID, I think these policies, deleveraging policies and so on, are a bit interrupted by the COVID pandemic and a bit also by the trade war. But as the economy started to recover pretty strongly in the second half of last year, they already returned to talking about deleveraging. They started to exit from the very relaxed monetary policy already in the second half of last year and tightening rules on developers on property. So I think, of course, it takes some time for those policies to have impact. But it also, some of these pent-up demand in housing start to fade, and so one after another things come together. So I don't really see this as coinciding with the regulation or common prosperity that we are talking about in terms of the rule change, because it's not a sudden rule change. The rule has been here for some time. But I think controlling property price and preventing property bubble is also in line with, boosting domestic demand and common prosperity, because they see not only this is a big potential macro risk, but also property price increase and the difference in the wealth gap in China because of the property price is also huge, and young people who couldn't afford to buy property, and it's affecting their ability to consume, and it's also affecting their intention to have family and children. So there's a number of things related to that.
Related questions that we get from several participants is whether you see the property tax project being implemented. This has been discussed for years, if not decades. What are the prospects for that right now? And can you explain us what the trade-offs is?
Sure. So property tax actually has been discussed for over 10 years. And in the last couple of years, actually, there has been less mentioning of property tax, and it's not even on this year's legislative agenda. However, I think the government has talked about establishing a legislation that allows for property tax for some time. And you can see the term is, prudently and proactively, but prudently push for this. I suspect that they will probably have a law first, but then give discretions for local governments in terms of how they implement it. I think the central government is very aware of the super importance of the property sector for the economy, and a nationwide property tax will have significant negative, at least sentiment impact on the property market. So I think they will be quite careful. There could be more pilot programs. There could be, have a legislation, but then allow some transition time and discretion for different local governments to implement it their way. So the law, I think, will come out in a way that the majority of people would not have to pay property tax. So I think the law could speed up in the next couple of years, but it's certainly, I don't think it's the government intention to crack down property sector no matter what. What they want is a stable development, healthy development of the property sector.
Do you see this real estate dynamics the same way as Tao, or do you have a different view?
I think I have a similar view. I think the government is in a very tough position. They recognized, I think back in 2017, even at the highest levels, that financial risks were increasing and that they needed to begin a process of deleveraging that obviously would have a negative impact on the property sector. And as Tao said, they had to relent a little bit in the pandemic, and now they're trying to get back to the point that they were, let's say, in 2018, 2019. So they don't want to destabilize the market, but they want to reduce the leverage in the sector. And I think it's a very, very precarious balance. And we've seen now that when you reduce the flow of credit to the developers, that many of them are going to run into significant difficulties given the high degree of leverage that has built up in the sector. So I think probably they're going to have to relent a little bit, allow a little bit more credit to flow to property developers in the short run so that they can complete some projects. But I think the long-term goal of reducing leverage remains. So I think this is a story that will continue to play out for quite a while.
Do you think, Nick, that Tao?
Sorry, just to add to what Nick said, Chinese government tend to be quite pragmatic and they adjust. So today already, a PBC official already explained, probably in response to some reports, that banks are told to increase their quota to the property sector, that they have instructed banks to act properly to ensure the stable development of the property sector, which I think in code word, that means a little bit of relenting, as Nick mentioned.
That raises a question of the impact on Chinese growth, right? Because even if I think all three of us assume Evergrande and other property crashes don't result in financial instability, the resorption of all this debt pile and elements of property bubbles on the basis of comparable experiences in other places is going to have a downward impact on future Chinese growth. Do you have an estimate on how severely that could affect the medium-term growth prospects of China, Nick?
Well, I think there's a great deal of uncertainty trying to come up with a number, but I think the effect is likely to be fairly modest. It might be a percentage point or slightly more of growth over the next couple of years, but I don't think we're going to see a major decline in the growth rate. And I say that because I think the demand for property remains relatively high. China does not have any of the characteristics that we had in the property market in most Western economies, and I think people lose sight of that. And I've mentioned 4 factors. Mortgage loans are recourse loans, so you can't just walk away from a property if the price goes down a few percentage points. The lenders can go after your other assets. Secondly, China does not have securitization. So a financial institution that makes a mortgage, the mortgage basically stays on their books. So they're actually interested in knowing about the capacity of the borrower to repay, which was certainly not the case in many Western countries. Third, China does not have home equity loans. So you can't and they don't have refinance. So people can't just continue to build up their leverage if the property prices are going up. And most importantly, they have very high down payment requirements. So I think the dynamics are likely to be quite different. Trying to anticipate what's going to happen in China compared to what happened in the US or Spain or some other places.
Actually, what you described shows a difference with the US, but I think it's very similar to Spain.
Well, I don't think we will have, in the US, we had a lot of foreclosures. There are not going to be foreclosures in China because people are not going to walk away from their properties because they have 30, 40% equity to begin with.
But my point is, if you look at the number of property bubbles outside of the US, and the US is a very specific property market, you see the same characteristics, right? No loan equity, no mortgage equity loans, no securitization, no walk-away clauses. I think Spain fits that picture quite perfectly.
Well, we'll see. I think the main point, I think, is that China is going to need fairly quickly to move to make sure that people that have already paid for houses get their houses. So I think we'll see a reassignment of projects to other developers. Remember, Evergrande is big, but there are thousands of property developers in China. I think if they don't do that, then the whole idea that's so widespread in China that property is a good asset class, if that starts to erode, then the macroeconomic consequences will be quite significant. But I think if everybody sees the people that paid for these properties actually get them, I think it's likely to remain the case that property is perceived as a good asset class. And I think we'll see minor corrections in prices, minor slowdown in sales and new construction starts.
How are you as sanguine as Nick on the medium-term impact on growth? Again, not talking about financial instability here.
On the medium term, yes, I think I have a similar view. In the short term, maybe I'm a little bit more concerned. So we are, it's very hard to predict, of course, and but I think in the worst case scenario, we could see sales and starts down 20% and the housing investment down 10% or so. And given that housing as a share of GDP in terms of, what percent of final products of GDP goes to housing, it's about 25%. If you include all the goods and services, construction material, auto, and so on and so forth. So it's very important. And therefore, I think in the short term, there's definitely significant downside risk because of the housing downturn. I think the authorities, of course, why it's so hard is that how will the government react? As we just mentioned, they already start to relent. And Link is absolutely right. Social stability is always important. So they want to make sure that people don't protest that they lost their down payment because the project is not finished. So they will ensure ongoing project. And also they may ease on mortgages in terms of approval speed. Of course, the government can take other measures, increasing public rental construction, increase infrastructure, and so on. What they care is about growth, right? So I agree. I think the mortgage side, the household balance sheet side is very different in China. But the linkage is really through the supply chain of housing. And so the government therefore focus on things like housing starts, investment, and therefore they can also try to counter by, for example, increasing rental construction, old town renovation, infrastructure, and so on.
You mentioned the 25% of the economy driven by real estate. Caroline Atkinson in the Q&A goes as far as 1/3, and she asks if this is to shrink, what takes its place. Nick, I think you've been commenting on that number. What's your estimate of the role of real estate in the Chinese economy?
I have to look in more detail, but I think the 25% is probably an overestimate. It is based off the entire property sector. And what we're talking about today is a part of that, which is residential. China also has a very big market for retail, malls, and stores of various types. And there's been, they also have a very big market for office buildings. So when you make an estimate for the entire real estate sector and come up with 25%, I think you're overstating the problem that China currently faces, which is, as far as we can see, at least I can see, is almost entirely in residential property.
You're right. The 25% is including all property, not just residential. However, I think the office space, which is a big part compared to retail and malls and so on, a lot of that is constructed by companies and local governments and institutions and so on. So when the general property market goes down, they tend to go down too. So it's hard to predict, but you're right. This 25%, which is from the input-output table, input-output coefficients definitely includes everything, not just the residential.
So let me come back to the title of the session. Does China still want to attract global investors? And here I want to introduce a distinction between the notion of market orientation of the Chinese economy and the openness to private sector investment in China, but from a domestic perspective. And Tao, you told us that the general market orientation is unchanged. But that's one thing. And another thing is the role of foreign capital, foreign investors, foreigners in general. And we have a number of questions around those themes. I'm not going to mention them all, but let me mention a few. Rob Donner asked about the role of foreigners in the Chinese investment going forward. Karen Sutter asked about sectors which are still close to foreign investment, including some of those which have been the target of the recent crackdown. An anonymous question is asking whether China is now receiving more FDI from the US. Paul Chiu is referring to the military tension in the region. Some of them was responsibility from Chinese government initiatives, which may be a dampener on foreign investment. Another, or maybe the same anonymous questioner refers to the possibilities that Evergrande creditors may be more penalized if they're foreign than if they're domestic. Mark Zashin is asking about foreign investment in the financial sector and whether the opening that was announced recently may continue. And maybe last but not least, Sharmin Mosaba Rahmani is asking why the purchase of Soho by Blackstone was blocked. So you have an ample menu of themes here. I'm not expecting that you will answer them all, but basically the question is, I mean, we know that China has a lot of savings, it has surplus, it can invest in the world, but is there still interest? I'm not talking about the numbers here. Is there still interest from the Chinese authorities to attract investment from outside China? Tao.
Yes, I think the answer is yes. There is still very much interest from multiple fronts. You're right, the capital is not the dominant motivation. That was maybe the case in the 80s, 90s, and so on. But I think foreign investors, in terms of foreign direct investment, they also bring technology and know-how, best practice, standards. And also, I think China's own experience have shown that competition in the end is good for China's own domestic companies as well. I mean, they can see over the last 30 years, the companies that are in the competitive sector, maybe in the beginning they were hit, but in the end there are strong companies emerging from that. For example, in consumer electronics and appliances, those sectors. When I was younger, the market used to be dominated by foreign brands. So I think competition with foreign companies in the export market really helps, and so at home as well. And also, I think, so technology in some areas, maybe technology is not very willing to come, but competition, know-how, and standard and practice, that is also very important. The last one especially is very important in the financial sector. I think the government is very keen to continue open financial markets and in inviting foreign investors in the Chinese market. And that, I think, first of all, Chinese market right now is still very dominated by retail investors. They want, solid institutional investors, including foreign institutional investors. And they see them bringing better practice into Chinese market if you want that market to be sort of a sustainable, high standard market. And we have seen roller coaster movements in the Chinese market in the last 20 years, and there are definitely some structural issues there. And also, I think there's a desire to stay integrated with the global markets, in the goods markets and also, as well as in the financial markets. I think a Chinese government may see that as a better defense against the decoupling pressures and all these, sort of national security or ideological hawks, in both sides of the Pacific. Is to stay engaged and have interest, mutual interest, economic interest. So I think that's also a very important motivation. And for some other, I think, Chinese thinkers and officials, also they feel that the competition, the foreign presence can force more reforms, more structural reforms. As well. So they see that as a motivation to continue to welcome foreign investment. I think I'm not sure about the latest data. I think FDI from the US have actually been increasing. Nick probably is more update on that. So there's definitely increased interest from the US, especially in the services sector, in financial industry. What we noticed increasingly is that foreign investment in China nowadays is not so much about using China as an export base, but more about serving China's growing market. So I think it's a different kind of foreign investment that coming to China.
You mentioned the Chinese government trying to fight the risk of decoupling, but you also mentioned before dual circulation. Can you, in Western commentary, dual circulation is often presented as a form of shift towards self-reliance and autarky. Can you give us your take on what dual circulation means and how we should think about it?
Dual circulation, I think, yes, with a focus on so-called internal circulation, domestic demand, right? So I think there's to me, it's a realistic recognition that, first of all, domestic economy is the bigger part of the economy. China is no longer export driven and cannot rely on that kind.
Oh, it seems you're frozen, Tao.
Things. And so there's a need to focus more on domestic economy. To some extent is, I think, hoping for the best, but preparing for the worst, in the sense that I think China still wants to be integrated, but, China relies a lot on foreign technology and imported components and so on. But if you, at some point, finding it difficult, as China was made acutely aware with the restrictions on Huawei and so on, then I think it will have to be self-reliant. So there is a focus within the dual circulation. There is a focus about technology self-reliance, supply chain resistance, meaning that if people cut off the supply, we can still survive. So it's about really preparation rather than just willingly turning inward. I think if given the opportunity, China still wants to import those technologies, still wants to be integrated. But I think at the same time, they're preparing for a less benign outcome.
Nick, do you agree on this?
Well, I think Tom makes a very good point. You really have to disaggregate in areas where the United States is imposing restrictions. China obviously is doubling down and trying to figure out a way to accelerate its own technological development, to be more independent, to be more resilient, and so forth. But I think if you look at the aggregate big picture, it's quite different. As I mentioned in my opening remarks, China's share of inbound foreign direct investment doubled in 2020. It's going to go up again substantially this year. This is how technology comes in. So yes, China wants to be self-reliant in semiconductors. It's going to take them a long time to get there. But meanwhile, you have a very substantial increase in foreign direct investment into the economy. It's mostly in services, which, as Tao said, that's mostly to serve domestic demand, which is growing quite strongly. Similarly, on trade, China's share of global trade went up dramatically in 2020 because its trade went up and global trade went down. This year, as I mentioned earlier, China's trade is growing 3, 4, 5 times faster than global trade. So dual circulation is kind of a nice bumper sticker, but you kind of have to disaggregate and see where the emphasis is on internal versus external. And I think the broad tendency is still, as Tao said, for deeper integration into the global economy.
So let me, as we're getting close to the end of the session, let me conclude with an issue we didn't raise, which is the monetary regime. And of course, these are slower moving issues, but we have several questions here. Sebastian Claro asking about the internationalization of the renminbi. Sharmin Mustafa Rahmani asking on whether China will one day remove capital controls and allow a free float of the currency. So I guess that's a longer term issue, but also an anonymous question about the possibility of the peg of the Hong Kong dollar being modified going forward, which maybe is a more less long term or maybe not. So Tao, how do you see the monetary exchange rate regimes going forward, both for the renminbi and also for the Hong Kong dollar?
I think the Hong Kong dollar is a longer term issue than the RMB. I think Hong Kong dollar change will have to come after RMB being fully more internationalized and the capital account is fully open, which I think will take a long time. Just considering the issues we have discussed, lack of transparency in policy, and also in terms of debt. So I think, what China is, what is not convertible, of course, is capital account, especially outflows from China, not the inflows, right? So I think this process will be quite gradual. China will have to reform its financial system, make the monetary policy framework also more transparent and more market-oriented. So I think, yes, I think the objective is moving in that direction, but that's more of a long-term goal to help achieve a lot of these reforms. So it will take some time.
No, Kamses?
No.
No comment at all. Maybe a word on the US. Mark Zashin is asking about your views of politicians in the US, warning about US investors putting their capital into Chinese equities that are related to security. Tao, does that have an impact? And do you see from your end of the market an influence of US political concerns over China at this point?
Those kind of warnings, I think, have very little macroeconomic impact. As we talked about, China relies mainly on domestic capital, not so much on foreign investment, and let alone U.S. investment in equities. From my conversations with clients, I think U.S. investors are also not necessarily that concerned about these politicians' warnings. And I guess they have to be concerned that suddenly a rule or a law is passed in U.S. Congress and forbid them to do something, especially on the public side, like if they manage pension and things like that. And also, with the U.S. government warning on U.S. companies operating in Hong Kong, I think U.S. companies operating in Hong Kong are not happy with that kind of warning, because they feel they understand the local situation much more. They understand the pros and cons and risks and so on.
Let me conclude with you. And Tao made, I think, a very crisp answer to my question about global capital by saying that capital is not the dominant motivation, but China wants to keep the openness because it wants to know how, it wants a connection with the world. Do you agree? Would you have a more nuanced view of this interplay between being open to market forces domestically versus global capital? How do you view that going forward?
Well, I think I've already given my view on this. I think the general pattern is one of openness, but they are going to try to increase self-sufficiency in certain critical sectors having to do with national security, high technology. And they were going down this road quite some time ago with various programs as long ago as a decade. And I think their move in that direction, or their motivation for that, has been dramatically enhanced given the relatively strict export control regulations that have been put in place by the United States. So again, I think the general picture is one of increasing openness, but in some areas, there's a huge emphasis on self-sufficiency. But we shouldn't just look at those areas and assume that China is closing, that it's all domestic. I think it's a more nuanced picture.
And I note that you just said increasing openness, not just maintaining openness. So you think that's the direction of travel at the macro level beyond these specific industries?
Well, when you look at the trade numbers and the FDI numbers, they're increasing dramatically as a share of global trade, as a share of global FDI. So I could turn around in a few years, but it's been a very strong trend in the last couple of years and certainly continuing this year.
Nick Lardy, Wang Tao, thank you so much for what I think was a very rich exchange, also an extraordinary engagement. I have to say from the audience, thanks to all the participants who asked questions and made remarks in our conversation. The next session of financial statements will be on October, I'm getting my notes wrong, October 28th. We'll discuss the German financial sector